What if you could retire not at 65, but in your 30s? Not by winning the lottery, not by landing a massive inheritance, not by starting a company that goes public, but by following a specific, mathematical, completely repeatable system that two ordinary people figured out from scratch and used to retire at 31 and 33 years old with enough money to never work again. That is the true story behind one of the most inspiring and most practical books ever written about financial independence. The book is called Quit Like a Millionaire. It was written by Christy Shen and Bryce Leung and published in 2019. And what makes it different from almost every other financial independence book is where Christy started. She did not start with advantages. She grew up in rural China in extreme poverty. Her family lived in a single room. She sometimes went to school hungry. She came to Canada as a child and started over with nothing in a country where she did not speak the language. By the time she was 31, she had retired with $1 million portfolio. And she and Bryce have been traveling the world on their investment income ever since. This is not a story about luck. It is a story about math. About deliberately learning the rules of the financial game and using those rules to engineer an exit from the traditional work and spend cycle as early as possible. In this video, I am going to walk you through every major idea in this book in complete detail. By the end, you will understand exactly how they did it and how you can apply the same principles to your own financial life. Let us get into it. The Poverty Math Lesson. Christy opens the book with a story from her childhood that shaped everything that followed. And it is worth understanding because it explains why she approached money so differently from most people. Growing up poor in China, she watched adults around her work incredibly hard and still have nothing. She noticed something that most children would not have thought to notice. The adults were working hard, but they were not building anything. They were trading their time for money and spending that money to survive. The cycle repeated endlessly with no escape. She decided as a young child that she would figure out how money actually worked. Not how it felt to spend it, how the math of it worked, how some people used the same amount of money to build permanent security while others used it to fund temporary comfort. This analytical approach to money became the foundation of everything she built later. She did not approach money emotionally, she approached it mathematically. And that shift in perspective, from money as something you feel to money as something you calculate, made all the difference. She says most people manage their money based on how it feels in the moment. Spending feels good. Saving feels like sacrifice. So they spend, and they stay stuck. The wealthy manage money based on math. They calculate what their choices actually cost over time. They evaluate options based on long-term outcomes rather than short-term feelings. And that mathematical clarity leads to completely different decisions. The FIRE movement. Before getting into the specific strategies the book explains, the philosophy it is built on. That philosophy is called FIRE. It stands for Financial Independence, Retire Early. FIRE is a growing movement of people who reject the traditional model of working for 40 years, saving a little, and hoping to retire comfortably at 65. Instead, they pursue financial independence as early as possible by saving and investing aggressively and living well below their means. The core math of FIRE is simple. If you save and invest enough money that your investment returns cover your annual living expenses, you no longer need to work. Your money works for you. You are financially independent. The specific number most FIRE practitioners use is the 4% rule. Research shows that a portfolio invested in a diversified mix of stocks and bonds can sustain a 4% annual withdrawal indefinitely. This means if your annual expenses are $40,000, you need a portfolio of $1 million to be financially independent. If your expenses are $30,000, you need $750,000. Christie says the most powerful insight of the FIRE movement is this: the less you spend, the less you need to be financially independent. Every dollar you remove from your monthly expenses does two things simultaneously. It increases the gap between your income and spending so you accumulate wealth faster, and it reduces the target number you need to reach financial independence. This double effect is why reducing expenses is so much more powerful than most people realize. Cutting $100 a month from your spending does not just save $1,200 a year. It reduces the amount you need to retire by $30,000 because you no longer need that income stream permanently. The yield shield. One of the most practical and original concepts in the book is what Christie and Bryce call the yield shield. Most people who plan for early retirement worry about one thing above all others. What happens if the stock market crashes right after you retire? If your portfolio drops 40% in the first year of retirement, you might run out of money before the market recovers. This is called sequence of returns risk, and it is one of the most legitimate concerns for anyone planning an early retirement. The yield shield is their solution to this problem. Instead of relying entirely on selling portfolio assets to fund your retirement expenses, you build your portfolio to generate income from dividends and interest. This income arrives regardless of what the market is doing. When the market falls, your asset values drop, but your dividends keep arriving. You can live on that income without selling any assets at the worst possible time. They recommend building a portfolio that generates yield from dividend-paying stocks, real estate investment trusts, and bonds. Not all of your portfolio needs to be yield-generating, but having enough yield to cover at minimum your basic living expenses gives you the buffer to survive market downturns without panic selling. The yield shield means market crashes become temporary paper losses rather than permanent financial damage. You wait them out on your dividend income while your portfolio recovers, and history says it always recovers. The math of getting there. Christy is an engineer and she approaches retirement planning with engineering precision. She breaks down the path to financial independence into a clear mathematical framework that anyone can follow. The first variable is your savings rate. This is the percentage of your income you save and invest every month. It is the single most powerful lever in the entire retirement calculation. She shows through specific examples how dramatically savings rate affects retirement timeline. If you save 10% of your income, it takes approximately 40 years to reach financial independence. If you save 50%, it takes about 17 years. If you save 75%, it takes about 7 years. The relationship is not linear. Each increase in savings rate produces a disproportionately larger reduction in retirement timeline because you are simultaneously accumulating faster and reducing the target number you need to reach. She says most people focus on earning more as the path to early retirement, but increasing income without increasing savings rate just leads to lifestyle inflation. The money disappears into bigger houses and fancier cars and more expensive habits. The path to early retirement is increasing the gap between what you earn and what you spend, and increasing that gap can happen through earning more, spending less, or both. The second variable is your investment return. Christie uses conservative assumptions of around 6 to 7% real returns for a diversified stock and bond portfolio. She says using conservative assumptions protects you from unpleasant surprises. If returns come in higher than expected, you retire earlier than planned. If returns come in at your assumptions, you retire exactly when planned. The third variable is time in the market. The earlier you start investing, the more time compound growth has to work. Every year you delay costs you far more than just that year of contributions because of the compounding effect on every dollar already invested. The Canadian Financial Framework. Christie and Bryce are Canadian, and some of the specific accounts and tax strategies they discuss are Canadian-specific, but the underlying principles apply universally regardless of which country you live in. The core principle is to maximize every tax-advantaged account available to you before investing in taxable accounts. In Canada, this means maxing out your RRSP and TFSA. In the United States, this means maxing out your 401k and Roth IRA. In the UK, it means maxing out your ISA. Every country has specific structures designed to shelter investment growth from taxation. Christie says using these accounts correctly can add years to your investment returns without any additional risk. Taxes are one of the largest costs investors face. Every dollar of tax you legally avoid is a dollar that stays in your portfolio and keeps compounding. She also discusses the sequence in which to use different account types for maximum tax efficiency. The general principle is to hold your highest growth assets in your most tax-sheltered accounts and your lower growth assets in taxable accounts. This ensures the most tax is avoided on the investments with the highest potential returns. She says most people are unaware of how much money they lose to taxes on their investments simply because they have never thought carefully about account structure. Learning the basics of tax-efficient investing is one of the highest return financial education investments you can make. Geographic arbitrage, making your money go further. One of the most creative and most powerful strategies in the book is what Christie and Bryce call geographic arbitrage. The concept is simple. The cost of living varies enormously between different countries and even between different cities in the same country. A lifestyle that costs $3,000 a month in San Francisco might cost $700 a month in Southeast Asia. A lifestyle that costs $2,000 a month in London might cost $500 a month in Eastern Europe. If your income is generated digitally, through investment returns, online work, or passive income, it does not matter where you are physically located. You earn the same amount whether you are in an expensive city or an inexpensive one. But your expenses can be a fraction of what they would be at home. Christy and Bryce have traveled the world for years living on their investment income. In many of the countries they visit, their portfolio generates significantly more monthly income than they need to live comfortably. They are not roughing it. They live well. They stay in comfortable accommodations, eat good food, and have rich experiences. They just do not pay expensive world city prices for those things. She says geographic arbitrage is not for everyone. Not everyone wants to live outside their home country. But even within a single country, there are enormous cost of living differences. Moving from an expensive city to a less expensive one while maintaining the same income can dramatically accelerate the timeline to financial independence. The principle is to think deliberately about where you live and what it costs you. Your location is a financial decision whether you treat it as one or not. The 4% rule and its limits. Christie spent significant time examining the 4% rule that most fire practitioners rely on, and she does this not to endorse it blindly, but to understand its limits and plan around them. The 4% rule comes from research called the Trinity Study, which examined historical market returns and withdrawal rates. It found that a portfolio withdrawn at 4% per year has historically survived all 30-year retirement periods in the data. But Christie points out an important caveat. The research was based on 30-year retirements. If you retire at 31 like she did, you are potentially looking at a 60 or 70-year retirement. And the longer the retirement, the more vulnerable you are to the scenarios where 4% fails. She uses a slightly more conservative withdrawal rate of 3 to 3.5% for extremely long retirements. This reduces the risk of portfolio failure over very long time periods. She also talks about building flexibility into your retirement plan, willing to reduce spending slightly during market downturns, willing to earn a small amount of income through part-time work or creative projects during bad market periods, willing to travel to lower-cost countries when markets are volatile. She says the 4% rule is a useful framework, but not a rigid law. The people who retire early successfully are the ones who understand the math deeply enough to adapt their behavior when circumstances require it, rather than mechanically applying a formula regardless of conditions. Overcoming the mental barriers. Christie addresses the psychological barriers that prevent most people from pursuing financial independence even when they intellectually understand the math. The first barrier is what she calls one more year syndrome. This is the tendency to keep working just a little longer before retiring even after you have reached your number. One more year to build a bigger cushion. One more year to feel more secure. One more year to be absolutely certain. She says this syndrome is driven by fear. Fear that the calculations are wrong. Fear that something unexpected will destroy the plan. Fear that you will miss work more than you expect. She says the cure is to trust the math. If the math says you have enough and your plan accounts for conservative assumptions and reasonable flexibility, then you have enough. Continuing to work beyond your number is trading your most finite and most valuable resource, your time, for marginal additional security that the math says you do not need. The second barrier is identity. Many people are so deeply identified with their job that the thought of not working feels like a loss of self. Who am I if I am not a doctor or a manager or an engineer? She says this is actually one of the most important things financial independence clarifies. It forces you to figure out who you are beyond your job title. And most people who make this transition discover that the identity they build around their actual interests, values, and relationships is richer and more satisfying than the identity they built around their career. The third barrier is what others will think. Retiring in your 30s invites judgment from people who believe that work is virtuous in itself and that leisure is something only old people deserve. She says the solution is to be clear about your own values. If your value is time and freedom and experience rather than status and career advancement, then the opinions of people who value different things simply do not apply to your life. What to do with your time? A question Christie addresses directly is the one that makes many people hesitate about early retirement. What do you actually do all day if you are not working? She says this question reveals how thoroughly most people have allowed work to structure their entire lives. When work disappears, the lack of structure can feel disorienting at first. But she says, the people who struggle most in early retirement are the ones who retired away from something, away from a job they hated, away from a commute they despised, away from a boss who made them miserable. The people who thrive are the ones who retire toward something, toward projects they are passionate about, toward relationships they want to deepen, toward experiences they have been deferring, toward contributions they want to make. She recommends thinking carefully before you retire about what you are retiring toward. What would you do with your time if money were no object and no one was watching? What problems in the world do you care enough about to work on without payment? What skills have you always wanted to develop? What places have you always wanted to see? The answers to these questions are your retirement plan, not just the financial plan, the life plan, the reason all the math and all the discipline actually matters. She says financial independence does not give you a better life automatically. It gives you the freedom to build one. What you build with that freedom is entirely up to you. The final thought. Quit Like a Millionaire is ultimately a book about two things: the math of freedom and the courage to pursue it. The math is learnable. Save aggressively. Invest consistently in low-cost, diversified funds. Minimize taxes through intelligent account structure. Reduce your spending not through deprivation, but through clarity about what actually makes your life rich. And reach the number that makes work optional. The courage is about choosing a different path from the one that everyone around you is following, about resisting the pressure to spend your raises and inflate your lifestyle, about tolerating the discomfort of living below your means now in exchange for decades of genuine freedom later. Christy Shen started with nothing. She grew up hungry in a single room in rural China. She arrived in Canada without language or advantages, and she retired at 31 with $1 million portfolio by simply learning the rules of the financial game and playing it deliberately. Her story is not about extraordinary luck or extraordinary talent. It is about extraordinary clarity. She decided what she wanted. She learned how the math worked. She built a system around that math, and she followed the system until it delivered what she had calculated it would deliver. That same clarity is available to anyone willing to learn the math and make the decisions it requires. The question is not whether you can do this. The math does not care about your background or your starting point. The question is whether you want financial freedom badly enough to make the choices that produce it. Start the math today, because every day you wait is a day you are trading the most valuable thing you have for a paycheck that was never going to be enough anyway. Thank you for watching. If this video gave you a clearer and more inspiring picture of what financial independence looks like and how to build it, please share it with someone who needs to hear it. Subscribe for more deep book summaries every week, and I will see you in the next video.